Hi, everyone, and welcome to Investing Strategies. On this episode, we're sitting down with the CEO of DocuSign, a huge software winner in 2020 that's back in focus after surging higher on the heels of an impressive quarterly report. Plus, Tesla and Chinese electric vehicle stocks are starting to rev back up, while Ford and GM have made big moves this year. Here to weigh in on the factors impacting the electric vehicle landscape, from established players to new startups, is IBD News editor Ed Carson. And there are more new developments in the big tech antitrust battle. IBD tech reporter Brian Deagon brings us up to speed on the ongoing drama. Investing Strategies starts right now. DocuSign stock surged 20% in early June after an impressive quarterly report, and a continuation of that move to the upside translates to a roughly 40% gain for the month. DocuSign CEO Dan Springer is here with a look at how the software company is positioned for its next phase of growth. Thanks for joining me today, Dan.
Thanks for having me.
Now, a lot has happened since we last spoke in April 2020, and it seems like the business is continuing to pick up steam, with estimate-beating quarterly numbers reported this June and solid guidance as well, suggesting the strong growth is expected to continue. And you've said you see the implementation of DocuSign services as a strategic priority for the business world at this point.
I think it's exactly right. Yeah, we were quite pleased with the results from Q1. We had not sort of expected maybe to be quite at that 58% revenue growth. So that was positively received, as you mentioned. But I think the core underlying trends are just as you said. We really see that the demand for people in this anywhere economy to have digital transformation is only increasing. So while we were pleasantly somewhat surprised at that strength, we're not surprised at all that the underlying demand is there for DocuSign.
Well, let's dig a little bit deeper into that. What trends are you seeing on the customer retention and customer acquisition front, especially as we're getting to the other side of this pandemic?
Well, it's interesting. Both sides were quite strong. We had a record from a standpoint of our customer retention. We use that net revenue retention number. We hit 125%. And of course, the range we've seen in the past, we sort of thought that would be about 112 up to about 118, 119. Last couple of quarters, we've been above that. And then at 125%, that significantly exceeded the rates we've had in the past, which is fantastic. And what we find at DocuSign is when our existing customers adopt the software, they get a tremendous return on that investment, and they tend to buy more. They tend to find more use cases to use the software. So not surprising. On the new customer front, it's kind of a milestone for us. We just announced that we passed 1 million paying customers, which is great. And I think we're seeing that same phenomena. The companies that haven't started that transformation, haven't sort of really brought their business forward, into a digital model, are starting to do that again at record numbers. So we see kind of both sides of the equation being pretty strong right now.
And the company's business outside the US contributed to a considerable chunk of DocuSign's total revenue in the first quarter, over 20%. So give us your assessment of the international market, which seems like an area of focus for you at this time.
It absolutely is. And to be fair, we're below where we want to be, right? So I think for a company, we talked about being about $2 billion in our guidance for this year in revenue. I'd like to see us significantly above that 21% outside of the US. So we have work to do. But obviously the growth, over 80% growth out of international in the quarter was quite strong. We're making big investments there. Europe is the market that we're making, I think, our biggest investment and where we see our strongest performance right now. But I also look at LATAM and looking at Asia Pacific and Japan, we do see growth really across the board. I think our biggest challenge is that there's realization that there's so many markets for us to go into. So it's sort of that sequencing and prioritization to make sure we're putting the right focus in the right places. But I think you'll see us continue to put up big numbers and have international sort of take a bigger and bigger piece of that overall share.
Some interesting trends there. Now, e-signature is still, of course, the core of your business at this stage, but with all the different use cases that you're seeing for all sorts of industries, what's next on the horizon in the agreement landscape that's ripe for disruption, you think?
Well, I think the real answer is you can't really talk about DocuSign without talking about e-signature, right? That is clearly what brought us to the dance. And I don't think it's going to change anytime in the near future. And we love it. I've said since we went public that we could continue to grow at high growth rates if we only did e-signature. But we saw from our customers that there was this opportunity to serve their needs more broadly. And what we've now created is the DocuSign Agreement Cloud. So not just signing, but also preparing those agreements, routing them around, having them integrate through APIs with your other software, and then, of course, managing that sort of repository of agreements and using advanced analytics to really get insight to your business. Those are all the areas that we see the growth on top of just continued expansion of e-signature.
And when you talk about physical to digital, one area of interest is notary solutions. What is DocuSign doing on that front?
Yeah, so notary has been one of these areas where we've had so many calls from customers to say, what you did for e-signature, could you please do it for notary, or what you did for physical signature with e-signature, could you do for notary? So we made a pretty big investment in the area. We actually just announced that we've gone to full remote online notary capability, just rolled that out. We're excited about that. And remember, we were starting with what we talked about last time as we call first party notary. And that's where a company, like a big financial institution, has their own notaries in-house. And then after that, we'll be rolling out third-party notary at the end of this year, where people have the ability, two people, you and I, decide we want to notarize a transaction. We can go to a local notary. Instead of having to physically go there, we can access that same notary, but all online in a remote model. And that'll be coming later this year. So it's going to be a big growth area for us. And again, part of this is a business growth area, but part of it is we see it as sort of our mission to help make the world more agreeable and to make that easier for people to do agreements. We think notary is a key part to fulfilling that mission.
Now, you've talked about the big market share lead that DocuSign has in this space. You've made a number of strategic acquisitions. The international business, as we said, is in early days, but encouraging numbers there. As we progress through the back half of 2021, what do you think is going to be the key to unlocking even more growth at DocuSign?
Well, interestingly for us, we don't think there's going to be like a big M&A play, because there really aren't large at-scale players in the overall agreement cloud space like DocuSign. So when we do acquisitions, to your point, we'll probably continue to do what we've done in the past, much smaller deals that are sort of tuck-in, where we see someone that's built some fantastic technology that we think we probably could build ourselves, but they've got a head start. And they've also built some subject matter expertise and domain knowledge around the space. And we say, our customers need that in the agreement cloud, like we did with Spring, like we did with Seal. We'll probably do some of those little tuck-ins in the future. But in terms of what's really going to drive the growth, well, those things will accelerate our business. The core growth are the core sort of aspects we've had to date. There's so much pent up demand and unsort of fulfilled TAM. And the way I think about it this way is, we talked about the idea about a $25 billion TAM for signature and about another $25 billion for the rest of the agreement cloud. As I just mentioned, we're talking about $2 billion of revenue. We're very small penetration in that market. And as you mentioned up front, we are the dramatic market share leader in our core business. So from that standpoint, we've got a long way to go just with what brought us here versus having to go to a new level of growth levers. It's going to be a lot more of the same.
Well, the June quarterly report definitely got a lot of eyeballs on Wall Street, and we are going to be paying close attention to DocuSign as we progress throughout the year. Dan, thank you so much for your insights today.
Thanks again. Cheers.
And coming up next, electric vehicle stocks are revving back up. IBD News editor Ed Carson breaks down what's behind their charge higher.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
After huge moves in 2020, Tesla and Chinese electric vehicle stocks NIO, Li Auto, and XPeng cooled off for much of this year, while Ford and GM took the spotlight. But as growth moves back into favor, EV stocks are revving higher in a big way. Here to break down the ins and outs of the electric vehicle market from an investor perspective is IBD News editor Ed Carson. Thanks for joining me today, Ed.
Thank you, Allie.
So when people think of electric vehicles, Tesla, of course, comes to mind, but traditional automakers like Ford and GM have serious EV ambitions as well. China EV stocks are back in focus too. So what's your assessment of the competitive landscape for the electric vehicle market at this juncture?
Well, it's a really fast moving. It's a big, fast growing market. You sort of have the four tiers. Yeah, on the top you have Tesla, sort of standing by its own. Then you have companies like NIO, Li Auto, Xpeng, which actually are producing cars and growing rapidly. You have the startups like Fisker, Rivian, which will supposedly be delivering cars in next month and having an IPO. A lot of cars like that. And then you have Ford, GM, VW, and all the other traditional automakers coming in. It's a really interesting mix of innovation and traditional manufacturing expertise. It's demand driven by regulators in many ways rather than consumers. So it's a very interesting market, a lot of opportunity. There's going to be a lot of losers in this market too, presumably.
And it's not just the quarterly reports that have the potential to be big catalysts for some of these stocks. You have monthly production figures, special events, and other announcements. Ford, for example, got a boost on its EV F-150 launch. So there are a lot of headlines with the potential to really move these stocks.
Yeah, absolutely. Monthly figures. It's interesting. Companies usually they aren't too excited about, boy, we're going to spend tons of money that might impact our profits. But when General Motors says we're going to revamp a bunch of plants, that can get the stock moving higher as well. There's a lot of things that can drive the stocks right now. People are very excited about progress. And it's not just about the numbers today. People are looking for growth in the future. If you're betting on these stocks, whether it's Tesla, NIO, or even something like Ford, the EV nature is something you're expecting strong growth for years to come, not just today. And so anything that people see from announcements that suggest that there will be further growth going forward, that people are going to take advantage of it, is likely to be a catalyst for these stocks.
And the chip shortage is also talked about a lot in tandem with the auto industry. So how is that impacting the equation for these automakers?
I mean, it's sometimes going to be a hit or miss. NIO in particular has acknowledged, yeah, we haven't been able to make as many EVs as we'd like, and it's something that's hit the whole industry. On the flip side, there's a sort of a general positive because the cars are like chips are in short supply. Cars are in short supply. Tesla's been raising prices this year in the U.S. Basically, everybody has pricing power. So whatever they are selling, they're selling at a premium, despite what you might expect increased competition in 2021.
Now, when it comes to the China EV stocks in particular, there's potential regulatory risk related to China and accounting related risks as well. What should investors keep in mind when they're looking to invest in these China EV players specifically?
It's just something that with any China name, when you're investing in that's always an added risk factor. Now, some of these companies have been around a little longer. So, you might feel like they're less likely to fall into accounting issues, but, you just never can tell. And on the regulatory front, if China wants to turn on a dime and say we're cracking down, they can crack down really fast. And there's not a whole lot companies can do about it. Tesla's faced a little bit of seeming some pressure, not nearly what Alibaba's faced earlier this year, the Chinese e-commerce giant, but that's always a sort of an existential risk. In the US, you're not worried about a regulator just literally just stomping down and crushing a company out of existence. That's actually something you could potentially worry about in China.
And these EV stocks have been pretty hot lately, but with any hot trend, you don't want to just be blindly buying because you're seeing that it's a hot trend. It's still important to do that due diligence, that analysis, not just on the fundamentals and the trends impacting the group, but taking a look at those charts as well.
Yeah, I mean, I think you really have to pay a lot of attention to the technicals, especially since you're betting on future growth. You can look at the fundamentals, and that's great, and that's important. But the technicals, like with Tesla's a great example, a tremendous run in 2020. But there were times, like if you had bought it, say at the peak in February 2020, the temporary peak, it just crashed like 40%, 50% from there in a matter of weeks. So if you bought at the right times, you often could get really big gains very quickly. So look for those buy points, look for those key resistance areas. Don't just buy willy-nilly in a stock, because some of these stocks might be on a good trend and then they'll just fall 30%. And you don't want to be caught out of that. You want to buy at the right time. So you take part in a winning trend, not chase it afterward.
Always important to remember. Ed, thank you so much for breaking down the driving forces behind the EV industry. We really appreciate it.
All right, thank you so much.
And coming up next, IBD tech reporter Brian Deagon is here to fill us in on all the ins and outs of the ongoing big tech antitrust battle.
Good morning, everyone, and welcome to IBD Live.
We're here to help you make more money in the stock market. On IBD Live, we give you actionable trade ideas every day. We follow the entire trade, buying, holding, and selling. We've built an amazing community of investors. They're excited to join us every morning, and we're excited to talk with them and take on the market.
Here now to bring us up to speed on the ongoing big tech antitrust battle and the risk posed to investors and opportunities as well is IBD tech reporter Brian Deagon. Thanks for being here today, Brian.
Very happy to be here with you, Valley.
So with the ongoing antitrust battle with these mega cap technology companies like Google, Apple, Facebook, Amazon, and Microsoft to an extent, what exactly is on the table here? We have lawsuits and legislation in the works.
It's something I like to call dogpile on big tech. Big tech in this case being Apple, Amazon, Google, Facebook, some cases Microsoft, and in some cases Twitter. And this momentum has been building for a couple of years, and it really started to hit a peak last year. And now this year, we recently saw here the introduction of 6 antitrust bills in the House Judiciary Committee that are specifically tailored at big tech and nobody else really. And, it's going to be a long process.
Mm-hmm. And so it's targeting so-called anti-competitive practices. What would you say is the likelihood of this legislation passing? It seems like there is bipartisan support, but the impact to these big tech companies is yet to be seen, but something investors need to be aware of.
Yeah, well, in terms of, there is bipartisan support, something we don't see very often, but it sort of ebbs and flows. And they're coming at it from different directions. But, when you talk about the likelihood of this passing, some quick history here. In 1975, there was United States versus IBM. It was an anti-monopoly lawsuit that went on for 2 years and then it was dropped without merit, and IBM walked away. The charge was that they had too much control over business computers, and they absolutely were the dominant force. And then in 1975, of course, the famous United States versus Microsoft case, in which Microsoft was charged with monopoly power with the operating system and the browser on their system. That went on for a few years and ultimately got thrown out because the government could not prove the case against Microsoft. So in fact, Microsoft basically got a slap on the hand, and you see where they are today, one of the biggest companies in the world. So that gives you an example. This is going to be very hard to win a battle like this, because proving monopoly is going to be extremely difficult, in addition to the fact that these companies have huge sums of money that they can use to spend on lobbyists and lawyers and whatever you want to fight them. So you're not going to see any changes soon. That's absolutely certain.
An ongoing battle it is, but if we did happen to see some tightening and some oversight on so-called anti-competitive practices, what would that look like? It sounds like it would result in some pretty significant changes to a lot of the services that we know and love and use all the time. But what do you think would be the impact of these companies if they did have to spin off their businesses in a big way, or be prevented from buying out smaller companies to expand their reach?
Yeah, well, the threat is real. I mean, these antitrust lawsuits are very broad and expansive, and to use an extreme situation, Google could be forced to divest YouTube. I mean, I absolutely do not see anything like that happening, but that's some of the direction that they're trying to go. They're claiming that these big techs have monopoly power in a way that crushes competition and innovation. So one of the areas they're going after is making it harder to do an acquisition, because as you often see, a $200 million company with a great idea gets scooped up by Facebook, and sometimes we never know what happens with it after that. A lot of this is what we call being baked in. The big investors are already sort of evaluating the potential outcome and have adjusted their level of stock interest in these companies. So to give you an example of what can happen though, recently here, Facebook won an antitrust lawsuit that the FTC had filed against them for monopoly power related to WhatsApp and Instagram. And that was filed in December. And when the decision came down, the judge said, sorry, FTC, you did not prove your case. You did not prove that Facebook has monopoly power. And the next thing you know, Facebook stock that same day hits a record high and reaches a valuation of $1 trillion for the first time. So once the pressure, once it becomes obvious what's going to happen, then you see these stocks react. But usually you won't see them react not violently, but aggressively until some decisions come down.
Mm-hmm. So even though there are potential risks here for investors, these can also be news headlines around and decisions around this antitrust battle can also be catalyst to the upside. Now, also, Brian, could you comment on the consumer side of this and what we're seeing on that front? In a recent IBD tip poll, there were some interesting findings around the support for breaking up big tech or not. Where does the consumer stand on this issue?
Yeah, I think when that poll was taken, I'm going to assume that consumers really didn't have a good enough background or knowledge of what potentially could happen or what was going on, because in the current antitrust case that's in the House, Google had made the argument that, hey, you guys better watch out what you're doing, because you could force us to effectively harm the consumer, to take away things that the consumers really want. You know how it is. Sometimes when you try to break something up, you make it even worse. I have a hard time actually seeing a major breakup in any way of these big tech companies. Proving an antitrust case is very difficult. And, and once the consumers start seeing that, hey, I'm going to lose this or I'm going to lose that, they're going to go, what? And they're going to raise their voices and the Congress is going to start to listen. I want to make a point here. Last year, they were working on what's called Section 230 of the Communications Decency Act. That was passed in 1976, and it is the law that is said to have built the internet because it gave liability protection to the internet companies. So, for example, if I posted something negative toward a person on Twitter, they couldn't sue Twitter, they would have to sue me. Twitter was not responsible for me putting liable content on their site. But this is where it gets rather strange because it came into focus because of the presidential election, where the social media platforms were so heavily used and abused that there was a lot of disagreement about what should be done. So they said, it's Section 230. We need to rewrite it or we need to throw it in the trash can. Those hearings went on for a while. The statement was that if they did rewrite it, they could rewrite it in a way that would force Twitter, Facebook, and all these social media sites to tear out of their systems any content that, say, I wrote and put on the website, because now they're responsible for what I write. So people wouldn't like that. I wouldn't like that, right?
Yeah, so that's yet another aspect of this antitrust battle. What would you say is the timeline that investors could expect this to play out? There's still a lot to sort through here. Do you think that as we progress and as these companies, in some cases, continue to expand their reach in various verticals, can we just expect this kind of friction to continue?
There's a lot of suits out there and moving at different paces. For example, the FTC suit that I referred to earlier has nothing to do with the 6 bills that were just recently introduced. Section 230 has nothing to do with that either. They're sort of separate. The other thing I would point out is Europe is going after big tech in a very aggressive way. They're finding their taxing their profits. They're doing a lot of stuff that the Washington legislators are looking at. And, Europe tends to be much harsher on these companies than the United States might normally be. So, I know Google, there's a Google suit out there, I forget which one it is, but there's an own suit against Google. Amazon is being pursued because of the way they treat their third-party vendors. And so there's a lot of moving parts. In the manner of speaking, you just don't know until you know, until it finally comes down. Like nobody knew recently here that Facebook decision was coming down. So usually these things happen and you find out after the fact, and the stock's already moved before you get a chance to do anything. But like I previously said, these are hard cases to prove. And me personally, maybe they're going to do some touch up around the edges to make it look like they did something. But I have a hard time seeing anything major that would cause one of these companies to be severely hurt. Again, referring back to Microsoft, I mean, that was a very aggressive case against Microsoft from monopoly power, and they couldn't do it.
Well, we'll have to see how it all unfolds. And we know, Brian, that you're going to be covering it and keeping us up to date every step of the way. But really good for investors to stay on top of this. If they own any of these stocks, they should be aware of the potential impacts of even just headlines with all of the antitrust drama. So thanks so much for being here today, Brian.
Thank you very much.
And thank you all for watching this episode of Investing Strategies for Investors Business Daily. I'm Alyssa Corum. Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.